Good morning, good afternoon, good evening. I would like to welcome you all to today's webinar on the future of U.S. capital markets, embracing transformation and regulatory change. CAPCO is a business and technology management consultancy operating primarily in financial services and energy sectors. I'll be your moderator today, Mark DeMaio, a strategic advisor and U.S. leader of CAPCO's go-to-market and solutions for both the capital markets practice as well as something we call FFRC, which includes finance, fin crimes, risk management, and regulatory compliance. We'll now move to our agenda. We'll start off with welcome and introductions. We'll share a little bit about the future of cap markets as we head into 2025 and look at some of the trends. We'll then cover our three feature topics: U.S. Treasury clearing, SEC lending, SEC Rule 10C-1, and securities modernization. We'll also have a Q&A and final thoughts at the end. Just some housekeeping on today's session. There will be a poll question prior to diving into each of the three featured topics. And if you'd like to ask a question, please use the Q&A function at the bottom of your screen, and we'll address those questions at the end of our panel. Kicking off, I'd like to introduce our esteemed panelists, starting with Chelsea Matias, who's a partner in CAPCO's global capital markets practice leader, a member of CAPCO's senior leadership team, and a leader of CAPCO's women initiatives. Next is Kit Spicer. Kit is a partner and CAPCO's co-leader of finance, fin crimes, risk management, and regulatory compliance practice. Next, Stefan Ritz. Stefan is a managing principal and an ops and technology executive and leads and delivers CAPCO's securities pre- and post-trade solutions offerings, as well as modernization. Matt Rogers. Matt is a managing principal and an investment bank broker-dealer executive, leading and delivering CAPCO's FINRA cross-product regulatory compliance offerings. Each brings valuable experience in cap markets across both domain and solutions. Now let's get started with Chelsea, our global capital markets leader. Chelsea, tell us about the capital markets practice at CAPCO.
Sure. Thanks, Mark. And thank you to all of our clients and market participants who have joined us today. We're excited to be facilitating this discussion. So for those of you who are joining us for the first time, my name is Chelsea Matias. I'm the global lead for our capital markets practice and the U.S. co-lead, along with Richard Malat, for our U.S. business. CAPCO was, the founding domain was the capital markets company 25 plus years ago. Today, we're about 750 plus capital markets practitioners globally. Our clients consist of regional and global market participants, and we look at it across 5 different categories. So investment banking and markets, securities servicing, FMIs, corporate banking, and central regulators. And I think, Mark, you said it well in your introduction. I think the CAPCO's ability to bring together industry subject matter expertise, along with the right service or solution groups across transformation, tech, reg, data, cyber, et cetera, is really what our clients look for us to do. CAPCO, continues to be considered a challenger brand, and we are very proud of that reputation. We thrive on market disruption, innovation, change, and I think most importantly, the thing we're most proud of is the fact that we deliver seamlessly for our clients. We're execution experts, and our clients really depend on us to do that.
Great. Chelsea, given all the change, can you share CAPCO's point of view as we launch into 2025?
Yeah, I think 2025 is going to be the first of a couple of exciting years that we have ahead of us. Our global practice just released our point of view on the top trends in 2025. some of which my US colleagues here are going to speak about a bit today. I'll go through those 5 now. So the first being a divergence in regulation. Regulation's not going away, but application by region is going to be different, causing some complexities for our clients. Securities market modernization. So off of the back of a successful T+1 implementation in the US markets, we're gearing up for the UK in 2027 and the rest of the European and Asia markets that have not yet moved forward to an accelerated settlement cycle. Platform modernization, so evolving new tech to really the heart of kind of financial services, money movements, sales and trading. So I think, we see, our CIO clients and operations clients ready to really harness some of the platform capabilities that are available through cloud and AI and et cetera. So how are we going to apply that with the right level of resiliency and controls? Adjacent to that is the interoperability of data and platforms, once again, to drive more insights, to drive productivity, to garner, AI and make the best use of data that's available. And all of that is going to drive really a changing market dynamic. So firms' ability is to react is going to be based upon scale and size. And, I think we've seen this year some of the smaller firms be able to drive growth quicker because they didn't have to worry about the scale and maybe some of the controls that some of the bigger players have. So it'll be interesting to see how those evolve, coming up in the near future. And I think that just kind of leaves a segue is that, this is really going to be about the balance of innovation, resiliency, the ability to focus still on cost, and really meet shareholder expectations on growth. So it's a lot of opportunity, a lot of challenges. And I think, like I said, you're going to hear a lot about that around from my colleagues here today.
Super. Thanks, Chelsea. That's a great platform and launch pad into our first topic today, the U.S. Treasury Central Clearing Market. U.S. Treasury market is the largest and most liquid sovereign debt market in the world. Treasuries, which are backed by the full faith and credit of the U.S. government, are widely held and actively traded by institutional investors, central banks, corporations, individuals, and many other private and public institutions. Because the Federal Reserve uses the U.S. Treasury market as a key tool to implement monetary policy, and the federal government relies on the sale of treasuries to finance essential services, the smooth and uninterrupted functioning of these markets is critically important to the strength and stability of the entire U.S. economy. Around 14 months ago, the SEC issued its final rule that requires central clearing for a majority of secondary cash trading and most Treasury repo financing activity. The U.S. Treasury market activity is split between 2 disparate clearing processes, bilaterally cleared transactions and centrally cleared transactions. Currently, transactions cleared through DTCC's Fixed Income Clearing Corp, commonly known as FIC, already surpassed 10 trillion in daily activity. DTCC anticipates that clearing could potentially increase by another 4 trillion as U.S. Treasury clearing becomes mandatory. Now let's ask our first poll question. What do you see as the biggest challenge in implementing U.S. Treasury clearing? Please take some time to respond. And it looks like technology upgrades and/or new technology needs are about half of our responses. Kit, can you please provide context for the U.S. Treasury clearing mandate and the objectives and key issues that are being addressed?
Yeah, sure. Thanks, Mark, and thanks. Hello to everybody, to all of our clients. And like Chelsea, I'm very excited for the next couple of years to see what kind of innovation is driven in the capital markets space. Yeah, a little bit of history here. So, just thinking about the market overall, I mean, this, as Mark said in his introduction, is a very large market, and the Treasury mandate is a significant structural change to that market, both the financing markets of Treasuries, but also the cash trading market. So, I mean, the way that we often talk to our clients about this is in terms of magnitude and industry effort. It's somewhat analogous to standing up OTC derivative clearing about a decade ago, and more recently, the transition from LIBOR to SOFR. So it's a really big deal. It's going to take a lot of coordination in the industry, and any structural change to this market really needs to be thoughtfully planned and carefully executed by everyone, really, the official sector, the private sector combined. And as Mark said in his introduction, it's really important that we get this right. And by right, I mean, we can't have a disruptive rollout when this comes live, because the Treasury market is, as Mark said, the most important financial market in the world. It sets key benchmark interest rates for risky assets worldwide. It's a key reserve asset for foreign banks, a major source of liquidity for global banks and asset managers around the world. And as Mark said, it's an important tool that the Fed uses when implementing monetary policy, and it's the mechanism that the US government finances its fiscal deficits. So having this market function smoothly during normal times is really important. It's also important that it functions well during stress periods in addition. And while Mark said, I think, sized the market at $28 trillion, 10 trillion of which is cleared every day, it's only getting bigger. So the Fed needs to refinance a lot of debt this year with some short-term issuance that was previously issued by the Treasury Department. And the overall size of the market is growing rapidly, and it's going to continue to grow rapidly over the next 10 years and beyond, really far outpacing GDP growth. So, Mark, to get to your question, I mean, Treasury reforms have been underway, or various reforms have been underway for about 10 years. The initial catalyst was the October 2014 flash rally, which really shined a light on structural need for change. So it really was the catalyst that brought to light some of the changes in this market, which were really the electronification of the market. So voice trading, most of the trading now is done through interdealer bank platforms electronically. Related to that is the rise of principal trading firms as an important source of liquidity. So, as market became electronified, it allowed the algos to come in and really begin to make markets here. And also related to that is that the banks themselves, due to post-crisis reforms, really became constrained from a leverage perspective and didn't allow them to meet the market intermediation needs of this really large market. So the official sector and the academics and the industry has really been studying this for a long time, but it wasn't really until COVID period, which really put a catalyst behind the efforts for central clearing. So it's hard to overstate the amount of stimulus and monetary support that the Fed provided during the 2020 market crash. A lot of people refer to this as the so-called dash for cash, when a lot of investors sold treasuries because it was the most liquid asset, but then the Fed had to step in a major way and support the market. So in terms of the objectives, I think, like I said before, the major objective is really to make the market more resilient to stress, and frankly, to avoid the need for the Federal Reserve to have to step in the future. Related to that, because more of the industry is going to go through clearing, there's a benefit of more transparency and more real-time data to the regulators. So to the extent that they need to provide monetary support in the future, they can do so more precisely and more accurately and in more real time than they were able to in the past. And of course, many of the financial markets have now gone to central clearing. The OTC swaps market, of course, futures have been cleared for 100 years. But so there's just the regular benefits of moving to a central clearing model, which is generally thought of as reducing counterparty risk, and then operational risk through multilateral netting. So, and then I guess last thing I'd say, Mark, is in this particular context, because of the large banks have had to pull back, unless there's changes coming forth in regulation that allow them to step back up, this having the market cleared and importantly kept off balance sheet will open up the market to potentially more competition in terms of market intermediation.
Great, thanks, Kit. Thanks for going deep on Treasury clearing. Question 2, where are firms at this point on their implementation journey? What are some of the key issues? And what do you see as the path forward?
Yeah, thanks. I guess that's the big question. So I'm going to speak about this mostly from a sell side point of view, but of course, this is a large initiative. It impacts infrastructure players like the clearinghouses themselves. It impacts a large set of buy side clients, many of whom are not who do not centrally clear products today. I'm mostly going to speak from the sell side point of view. And I'd say where firms are at is they've for the most part, exited their what I would call their strategic assessment phase, meaning they really looked kind of front to back at how the rule in concept impacts their various businesses and support functions. And they're moving really into the detailed implementation phase. So, Mark, as you mentioned, the rule's been out for 14 months, and we've been having conversations with our clients throughout that whole period. But things really began to accelerate this past summer. A couple things happened. One, the industry was very focused on T+1 implementation here in the US, which was largely successful and happened over Memorial Day weekend last year. And then two, a lot of the work to facilitate central clearing is really on the clearinghouse itself. In this case, the only currently approved covered clearing agency is the DTCC, and they published their rule book this past summer, which really gave the details behind what was mandated in concept in the rule. So in terms of timing, the first deadline is actually coming up this March. Most of that actually falls on the DTCC itself. They have a lot of operational work to do on their end, and to their credit, they've been doing it. They've been out very vocally in the industry, providing transparency on what they're doing and the path forward. I guess I'd make a quick distinction between firms that are already sponsoring members of DTCC. They will have this upcoming deadline of March 2025. They will have to separate their house and client accounts into different segments. But there's also a large number of firms that are not currently in the clearing business that are in the queue to become clearing businesses. And a lot of our clients fall into that category as well. So, Mark, if I can move on, just touching on the key issues, I think I'll broadly talk about them in 5 themes, and I'll just give a few examples for each. I won't dive into too much detail. And it's important to note they're not mutually exclusive. They really interact with each other, interlap with each other. So first, from a strategic perspective, I think there's a question about how firms are going to structure their clearing activities between their repo desks, their prime brokerage businesses, and their FCM businesses. Historically, this has been done through sponsored repo on the repo desk, but as many of our listeners will know, derivative clearing and prime brokerage is the model through which OTC swap clearing is made. So that's just an example of some of the strategic thinking that our clients are going through. There are a number of accounting and legal considerations that the industry is working through. I think the most important one to highlight here is the balance sheet treatment. There's a new model called done-away clearing, which essentially means you can execute with one dealer and then clear through another. The balance sheet treatment is still up in the air, and the industry is working hard towards that. The third bucket, I'd say, is risk and capital. Just touching on this briefly, there's going to be impacts to credit limits. There's going to be funding impacts depending on how and which client's margin is fronted on their behalf to the exchange. And then an important one is capital requirements, both for the activity itself, but looking forward for cross-margined activity between cash trading and futures trading. Of course, there's a huge operational component to this. So there's books and records, really detailed books and records flows that need to be implemented in collateral management processes that support that. And then generally just the operational capability of both the sell side and the buy side to kind of pass margin back and forth. Lastly, there's interpretive issues, and I won't really go into these, but I think the industry is very focused on these. There's just some issues that need to be resolved from the rule perspective in order to move forward. So those are the key issues, Mark. I think we're going to find out in the next week or so whether the extension that the industry has asked for will be granted, and then we're going to take it from there. But our advice is, keep plugging along. It's a major initiative, and I think whether an extension is granted or not, it's a lot of work that the industry has coming up.
Great, thanks, Kit. And I think we are seeing clients continue on, with their programs and not change their, project investment, if you will, and team. on these focused areas. But thanks again, Kit, for a great overview and response. So now we'll lead into our second topic, which is in and around securities lending and the SEC Rule 10C-1. Just a bit of an overview. Our former SEC Chair, Gary Gensler, said securities lending played a role in the 2008 financial crisis, and currently the SEC lending market is opaque. In the Dodd-Frank Act, Congress mandated that the Commission enhance the transparency of the securities lending market, and such transparency gets to the heart of the SEC's mission. So we're seeing common themes across these multiple topics. It promotes competition, it promotes fair and orderly and efficient markets. In fulfilling Congress's mandate, today's adoption will promote greater transparency in SEC lending markets, both to the regulators and the public. The SEC today, and most recently adopted a new rule called 10C-1A, which will require certain persons to report information about securities loans to a registered national association, commonly known as an RNSA, or more commonly known as FINRA, to make publicly available certain information that they receive regarding those lending transactions. The rule is intended to increase the transparency and efficiency of the securities lending market. Now let's go to poll question number 2. What do you perceive as the most challenging aspect of complying with SEC Rule 10C-1? Well, it looks like our responses are relatively even, and we'll talk a little bit about that as we move on. Matt, how do you anticipate SEC Rule 10C-1 impacting the structure and operations of both large and small broker-dealers?
Thanks, Mark. I'd like to welcome everyone here today. So it's always an interesting conversation when it relates to regulatory compliance. I mean, it's always an ever-changing landscape. We're always on our toes with regards to how they're going to enact things, when they're going to enact things, what the interpretation is. So anytime that it involves the global capital markets industry, there's always a variety of factors that we have to take into consideration. Whether you're a large firm or a small firm, how we interpret the rules is very important, and everyone interprets things differently. So ultimately, we lead to bifurcated compliances. We look at things where people are doing things in one fashion and others in another way, and auditors and examiners are having trouble trying to keep up, as well as when we do implementations with regard to our clients and reconciliations and the control processes around it. Firms also have different technology stacks. So not every firm is the same implementation. Not every firm operates the same way. So we have to take that into consideration. And sometimes this will either expedite the implementation or potentially impede their implementation based on the aging of this technology stack, the architecture, the framework, and a variety of factors, ultimately from a data side. And again, data is key to all of this because that's the purpose of the regulation, is around transparency. What we can say here is that all firms thrive on market intelligence and the subject matter expertise that allows them to determine the best course of action from a strategic standpoint, but ultimately to be robust enough when there are changes to the regulatory requirements, including 10C-1A, that we can pivot accordingly and ultimately adhere to those changes in a timely fashion. But we should also be cognizant of sustainability and not trying to comply with just the regulation to get it to the end date of January 2nd of 2026. But ultimately, we want to make sure that we are meeting and exceeding the requirements to allow for not only the ever-changing aspect of the rules or rules in this nature, but to ensure that we've got the appropriate processes in place and that we have knowledge transfer and education for these rules. So operational staff, support staff, the front office, and everybody as a key stakeholder can understand exactly what we're looking to implement accordingly. Regulators do conduct the exams. They operate on a 12 to 18-month schedule, and this is really where they come and test the rule and against the requirements, as well as the firm's ability to adhere to those requirements. So again, keeping with the word sustainability is we want to make sure that we are implementing the rule, understanding of the regulatory change, can support that process as a go-forward approach within the BAU environment, and test against it to make sure that these firms are complying as needed. So whether you're large or small, we have to make sure that the architecture, the governance framework, our policies and procedures are all updated. We're doing the cross-training, we're doing the necessary steps to make sure that we're compliant with the purposes of an audit or an exam, or just BAU reconciliations with the clients and their counterparts.
Great, thanks, Matt. Matt, as you advise our clients, member firms towards compliance and sustainability around the new requirements, what challenges are you seeing or foresee?
It's a great question, Mark. So as mentioned previously in the other response, all firms need to understand the requirement. We can't just sit here and just digest what's coming in from the regulators through a federal register. We have to apply the business acumen, ultimately the processes and the procedures, and ensure that whatever the risk appetite is of that firm is acceptable and we implemented it accordingly. So regulatory change should be a strategic focus for firms regardless. We all know that the firms want to implement new products. We all know the firms want to expand for their client base, but we have to make sure that we are, supporting things both domestically and internationally from a compliance requirement side of things. So that's an ongoing budget. That's the resourcing. That's the governance framework. All of these discussions are linked together as a firm's strategic vision, so we can ensure that they're at the forefront of the change, ensuring that sustainability that we focused on here today, and ultimately are successful. So the stakeholders associated with this, whether it be technology, your compliance and legal departments, your front office, in this case, it's going to be the securities finance business. In other cases, it could be your structured derivatives or your cash equities. Again, depending on the line of business at hand, they all need to be aligned on the approach. We can't just have bifurcated processes where we're just project managing something and we're looking to hit an end date and that's that. We can't just look at it siloed. We have to look at holistically to ensure that all of the program stakeholders are aligned, the governance is in place, and the learning and development is there so we can ensure that the proper compliance initiatives are adhered to. And we see this across the board, right? For the past 14 plus years, firms have been dealing with the Dodd-Frank Act. Firms have been dealing with the G20 commitments across the board. And there are still struggles, and there will continue to be struggles across it. So if it's a proposed amendment, if it's a new reporting requirement, just like 10C1A for the daily reporting of securities, a U.S. security loan, or updating their RMP, either way, we have to make sure that the sustainability is there for all purposes of the organization to be successful. The last thing firms want to see is either on the front cover of the Wall Street Journal, enforcement actions from a particular regulator, or anything in between that could damage the reputation of that firm if they're not adhering to, 10C1A or other G20 commitments. We also have to make sure that we're going to be looking at this approach strategically. What is that structure? How do we pivot if we need to? Do we need to, look at the technology stack, which in some cases in the organizations could be 20 plus years old, looking at COBOL code versus, Java and some Python. So again, we have to look at this as a wider view, not just a singular view on how we're going to adhere to these ever-changing requirements. The last thing I'll touch on is firms are about the ever-changing landscape here is at the pre-plan, right? We know that some of these rules carry a 12 to 18-month implementation cycle. We know, I think my colleague Kit mentioned 14 months that, the Treasury clearing rule was implemented. That's when we should all be starting to talk about this. We should be proactive instead of reactive as these swap data rules, these SEC rules, the NFA rules, the CFTC rule, all of these are going to be coming and changing. And we have to have robust governance in place to be better prepared as an industry together. I appreciate the time, Mark. Thank you.
Hey, Mark, can I make one quick comment? I mean, I think just as a macro level, right, is that the data demands on our clients are really high, right? So in this particular case, it's 10C1, but there's also non-centrally cleared bilateral repo requirements coming down the pike. Treasury securities, corporate bond reporting. So it's just really important for our clients to get the data right and be prepared to do it in a real-time basis. I think this is just a continuation of that theme.
Yeah, I would just add that, it goes back to the key themes that stated at the top in terms of interoperability of data and making that available instead of just looking at it from a regulatory compliance perspective. look at it in ways that can also drive insights for your business. So, firms who are able to bring all of that together and utilize it distribute it in a way that's effective for the right business recipient, it's a great way, right, to use these regulatory programs to also to drive kind of those business outcomes. Mark, I'll pass it back to you.
Thanks, Matt, Kit, Chelsea, on all your insights, and again, going back to themes: data, technology, federated, architecture, processes, and truly global are naturally, directions we're seeing the market, the market continue to head in, which is a great launching pad for topic 3 on securities modernization. Global capital markets players are showing remarkable resilience, navigating an increasingly complex environment, shaped by the confluence of macroeconomic uncertainty, geopolitical shifts, rapid technology advancements, heightened regulatory divergence, uneven regional growth, productivity expectations, and evolving client demands are creating a landscape that demands proactive adaptation, driving firms to reevaluate their strategies. Meanwhile, disruptive forces ranging from the accelerated pace of innovation to changing competitive dynamics are unlocking opportunities to reshape how markets operate. Most recently, US T+1 implementation this past year, and now we're seeing Europe and Switzerland, focused on their T1 initiative, just as one example. Securities market modernization, a key wave of market evolution currently underway, is the modernization of securities infrastructure, from clearing and settlement systems to accelerated settlements and the issuance of digital native assets. Regulatory reforms, global 24/7 trading and market demand for transparency are accelerating this shift. It's imminent. Platform modernization to meet the demands of an ecosystem increasingly driven by speed, efficiency, data-centric decision-making. Trading platforms must evolve. Investments in cloud-native solutions, AI integration, user-centric designs are enabling the transformation of trade execution and management. With that, let's go to poll question number 3. How ready do you feel your organization is in its modernization journey? Somewhat ready, strategy defined, implementation to be executed, 59%. Okay, so we march on. Stefan, as security markets modernize, what are the key operational and risk management strategies that firms should focus on to ensure a smooth transition and mitigate potential disruptions?
Hi, Mark. Hi, everybody, and thanks for having me here. Welcome to our guest. So, as you mentioned, there's definitely an appetite for securities market modernization. The response from the poll shows that most of our clients or most of the participants are somewhat ready, but are still working through their book of work implementation. Regulatory initiatives such as T+1 or even central clearing for US Treasuries are a good platform for firms to understand, how to modernize, what the pain points are, where are the areas of opportunities as far as optimization, automations, and things of that nature. So we are looking at, transformations from a people, process, technology element. T+1 was really focused on people and processes. As we gear towards, and that's in the longer future term type of timeline, but as we go towards T0, the transformation will be a lot more technology focused, where there will be a need to remove batch processes, increase straight-through processing across the entire trade life cycle. The panelists Chelsea, Kit, and Matt touched upon data. Data is very critical in terms of management framework, in terms of utilizing the right key data elements. And that's interesting or critical because of real-time monitoring, analytics, and predictability. In the context of settlement cycle, there's a massive use across the industry of analytics to predict fails, to reduce fines, cost of funding's implication, and more importantly, meet the new established timelines as it relates to allocation, affirmation, confirmation. So all that is critical. Now, as the settlement cycles accelerates, there are a few considerations, especially as it relates to your risk management frameworks, your strategies. The first piece would be around ops resilience and business continuity planning. Obviously, you do have less time to address some of those threats, those issues. So a true analysis of those frameworks need to be taking place. The second piece would be around policies and procedures updates to reflect those new changes, those new escalation cycles. And lastly, on that front, the RCSA framework, making sure that your risk and control framework is adequate, given the new process changes, if you will, and modernization objectives. Technology modernization is not a one-time initiative. It's a continuous improvement process where our financial institution client need to be able to pivot on the new regulatory change, making sure that they do not introduce additional risk into their process, that they're fully equipped to address those risks and mitigate them. The key definition of success here relies in terms of scalability, performance, as I said, ops resilience, cyber resilience as well, and overall, the reduction of total cost of ownership.
Thanks, Stefan. Second question for you. How do you envision the impact the new technologies on the future of pre and post-trade activities, and what challenges do you see in integrating those technologies into traditional systems?
Great question. So as mentioned, with the accelerated settlement cycles, it is almost impossible not to consider those technology. Blockchain, digitization of asset, DLT, AI, Gen AI, this is a must-have. There's obviously an enhanced focus on automation for pre and post-trade activities, especially as it relates to client onboarding, client lifecycle management, which is really the setup for success of your process. And then matching break resolutions. As the time allocated to that activity or type of activities is reduced, that automation is critical. We also see a lot of applicability of those technologies in terms of control functions. Collateral management being one, margin calculation, and that's particularly applicable to central clearing for US Treasury or any type of clearing activity. And there are few challenges, however, in terms of those adoptions. One is, do you have the right technology framework in place? Do you have the right scenarios or use cases identified for those technologies? Do you have the right governance in place, the right controls? So the last thing you want to do is, by identifying or implementing those technologies, you would increase your operational risk and exposure to potentially regulatory finding. Lastly, the introduction of new technology is a risk management impact. You need to ensure that the recalibration of your risk appetite framework, thresholds, is adequate. You have the right risk monitoring processes in place and related escalation protocol. And potentially, you would need to update your training material to make sure that there is some sustainability in place and that your personnel is well equipped with, mitigation and remediation steps.
I just want to echo Stefan's comments, because for those who are on the line who are members of SIFMA and were able to attend the SIFMA and FINRA regulatory panel last week, everything Stefan just mentioned, were laid out in the FINRA priority report this year as well, in terms of resiliency, controls, education, which Matt also referred to as he was talking around 10C1. And ensuring the right people have the right education for their function. So it seems a little basic at times, but I think, as Matt also said, where there's a lot of times that we're rushed to the finish line, and these are the things that regulators are going to be looking for through exams, through the risk monitoring policies, that we prioritize with our clients to ensure it's a part of the program.
Chelsea, if I could jump in with a slightly different slant too. I mean, I think particularly for our U.S. clients, I think we are going to enter a period of a more friendly regulatory environment when it comes to innovation and new technologies. Now, they need to be carefully thought out and the proper guardrails in place and control frameworks like Stefan mentioned. But I think what we're going to see is an opportunity for our clients really to experiment. I think Acting Chair Pham talked about regulatory sandboxes to play in. So really just to allow our clients to experiment with some of these new technologies, whether it's artificial intelligence or distributed ledger technology. So yeah, I think all in all, it's just an interesting, exciting time for the U.S. capital markets in particular. To really kind of enter this new phase.
Yeah, I think you're right. It's the right timing to have more of a industry level consortium of innovation controls and how can the industry react as a whole, like we saw in T1 when everyone's working together. These implementations can be a bit easier, even though they're not easy in principle. But it will be interesting to see if that's made available.
Great. Thanks, Stefan, Chelsea, Kit, for all your insights. That wraps up our 3 focal topic panel discussion areas. I'd just like to thank my fellow colleagues and our panelists for the insightful discussion thus far. We've covered a lot in these 3 topics. Now let's open the floor to our clients and attendees. Again, just a reminder, please continue to submit your questions via the Q&A function. We'll wait about a minute before we start.
Mark, we're going to need to get you a Jeopardy clock for the next webinar.
I was thinking the same thing.
All right, so the questions are coming in. Why don't we get started? And again, please don't hesitate to keep adding to the Q&A function. First question, what are clients focusing on for cost optimization, and what type of transformations are they considering? Stefan, why don't we start with you?
Sounds good. Thank you, Mark. So we talked about the modernization of ecosystems from an infrastructure, from a platform implementation elements, but there's also a few other considerations such as business process optimization or outsourcing, location strategies, especially as it relates to delivery centers, access to talent in lower cost type of locations, and obviously delivery model shifts. So we do see a lot of onshore, nearshore, offshore type of hybrid model to ensure some continuity of coverage, especially as it relates to accelerated settlement cycles, consideration given to extended trading hours, which is a new topic being pushed. So we do have the 22/5 extended hours, which will require a lot of additional controls to be put in place, streamlining of processes, especially as it relates to reporting, escalation, etc. So in addition to the modernization of ecosystems, access models or delivery models are definitely a topic that we see.
Yeah, just add on the from a total cost perspective, we're also seeing an increase of queries coming from clients around build versus buy. And as mentioned at the top, the market dynamics are changing a bit. Firms who potentially previously were not sizable enough to invest in their own technologies are now able to with some of the newer technologies that are available. So there's an increasing, once again, kind of, I think, question to Capco and to this team around how to stay competitive, keep costs down, once again stay resilient. So it's definitely, Mark, going to continue to stay a number one topic around kind of cost management as we're exploring all these new technologies.
Yeah, no, I agree. And we've met with some newer vendors in reconciliations, something pretty standard in our industry for decades. And there's new technology, new ways of looking at reconciliations faster, cheaper, smarter, even on something as kind of rudimentary, as that within the life cycle. Second question, what are some of the lessons learned? Europe, UK, Switzerland, where that could take away, right, from their upcoming transformation journeys. We just finished, here in the US on T1 as an example. And as I mentioned earlier, they're launching their T1 initiative. Stefan, you want to start on that one?
If I can go off mute. So obviously, there's the new journey to T+1 in the UK, Europe, and Switzerland. And there is a lot of lessons learned from the US. One key difference, if you will, is around the infrastructure. The US has only one exchange, if you will, which is the TCC. With Europe, obviously, they're dealing with a lot more, the Euroclear of the world, the SmartStream, etc. So there's a lot of connectivity issues that will need to be tested. There's going to be a lot of coordination between the various players and actors within the trade life cycle, especially if you are on the buy side leveraging vendors. Some of those scenarios will need to be pressure tested. Policies and procedures obviously will have to be completely gap analyzed to make sure that they are fit for purpose. The right controls are in place, the right reporting, et cetera, et cetera. So there is a lot of lessons learned, but a lot more complexity as far as I'm concerned with the adoption of T+1 on the other side of the pond.
And I would just add, even after the US's T+1 initiative, I think it was mentioned in SIFMA last spring, there's probably still 10, 15, 20% cleanup after the fact, which is ongoing, and it kind of falls into what we would term as modernization, right? So, as the US continues to modernize, Europe and the rest of the world will hopefully, benefit from that.
Just add on to that there. Sorry, Mark, just one thing, because I think on the lessons learned that we have the complexities of these markets, but also the advantage that they have from learning from the US on internal governance, on getting the program set up. I think we're seeing a lot of response from clients that they're going to use their task force in a similar way. So now they're almost able to focus more on some of these more complex challenges around technology because they're not really worried too much about the organization. So just wanted to add that layer in as well.
All right, just being respectful of time. Thank you, Stefan and Chelsea. Being respectful of time, we'll take one more question. Kit, I'll send this one to you. How are firms reviewing and testing operational mitigation plans?
Sure. I mean, well, I think I would start by saying that operational resilience is a major theme and has been for several years. I think one of the key themes we're seeing is a centralization of those efforts. So, for example, in the UK, you have the DORA initiative, or sorry, in the European region, you have the DORA initiative. There's various efforts across the US and Asia. And one thing we're seeing is actually clients strategically combining some of those work streams to really pull everything that has to do with resilience into one place. And so that is technical things like where server farms are located and ensuring business continuity from that perspective, but also kind of operational things like the control framework, making sure that the control framework that's in place not only supports its initial intent in terms of just making sure that the systems and the processes are well controlled, but that also they have that ancillary benefit of helping out from a resilience standpoint and really demonstrating, frankly, to third parties that the firm is resilient and can stand up to those kind of exogenous shocks. So I should say, there's a lot of interconnectedness in this topic. It ties into third-party risk management. It ties into business continuity. But we're starting to see all these things really come together under this broad operational resilience umbrella, and especially when you're thinking about securities trading or treasury trading. I mean, these are markets that have trillions of dollars of turnover a day. So ensuring that those markets are resilient, that the central counterparties in those markets are resilient, and frankly, all the major intermediaries in those markets are resilient is just critically important, both to the industry but also to the official sector. So we're definitely seeing, a C-level focus on this topic for sure.
Great, thanks, Kit. Well, let me just wrap up by saying thank you. I'd be remiss not to thank our internal Capco team, led by Candace, Alexandra, and Luke, for pulling this whole event together. Thank you again to our panelists and my colleagues for sharing their expertise. And thank you to all our attendees, our clients, for your active participation. We hope you found the session insightful. A link to the replay of the session will be shared post this event. And be on the lookout for more of our thought leadership in the future. Thanks again and have a great day.